Hello, everyone. Good evening. Let's wait a couple of minutes for more people. Well, I think it's time. So let's get started. I'm Dmitry Rybych, and this is the course Financial Modeling in Practice, or DCF Modeling in Practice. And during this course, it will be 7 lectures plus exam. We'll be learning how to build financial models for capital investment projects. So this is not about any type of financial modeling, because the term financial modeling is pretty broad and it can be applied to many different models. Some of you probably was at my course on valuation, and with valuation we use financial models as well. So you can use financial modeling for budgeting, for any type of analysis. But in this course, we'll be using Excel and financial models to evaluate investment projects. So wait a second. No, it's not correct. One second. Sorry, do you see my presentation now full screen or within PowerPoint?
Full screen.
Full screen, okay. Because I changed some settings in Zoom. I changed it from showing one separate window to one separate application, and now it shows demonstration and operational mode of presentation in the same window. Okay, so 1 second. Okay, let's begin. By the way, we have a very strange schedule this year because of we had one break because of maybe holidays then, and there was another shift because of pandemic restrictions, or maybe because of other things. So we'll have one lecture, starting lecture today, and then we'll have a break, I believe, for 3 weeks, maybe, or for 2 weeks until the next lecture. But Anyway, I don't think that this break or any schedule we have in our lecture should have big impact to what we're going to do within this course. I'll explain that later. So the schedule of our lectures is roughly going from the beginning of any model from empty Excel file, and then step by step to a complete model. And during the course, I will spend lecture times to show you how I would build a financial model for some example of a capital investment project that I'll give you today. And lecture by lecture, we'll go from basics of financial modeling, then to project assumptions, how we can model them, then financial reports, then finance of a project like loans, lease, equity, and we'll add all necessary ratios to our model. Then we'll have a lecture on DCF analysis, and this is that's a bit funny because we call DCF modeling this course, and in most cases we call the models DCF model, but actually in any DCF model, DCF part is like 5% of the model, and even more in some models you don't need this DCF part because the only thing you need from this model is the budget that you will use to prepare your financing schedule or things like that. So actually DCF models and DCF analysis is not that much about DCF. It's about forecasting of financial position of a company or of a project for any kind of analysis. So after DCF lecture, we'll have lecture on scenario analysis, and here I use scenario analysis as some broad term. We can call it what if analysis because scenarios are only one possible tool that we use in this what if analysis. And then the last lecture will be on venture business modeling, because our main project, the project I'll be using throughout the course, is more an industrial project, because with industrial projects you can apply all popular tools for financial modeling, like financing a project with loans, calculating financial ratios, DCF analysis, and so on. And with venture business, sometimes, not sometimes, in most cases, for venture business, you just don't need all that, because you don't finance venture projects with loans. You don't use regular financial ratios. You don't calculate in many cases. You don't even calculate DCF ratios, DCF indicators for projects like that. So we'll discuss a separate case for venture business models, and then the last lecture will be our exam, actually. But for most of you, you can avoid sitting for this exam. I'll explain you how. And the main part, the main idea of this course is not what I'll be doing here during my lectures, because financial modeling is not a theoretical topic. We don't have any theory on financial modeling, actually. I'll mention some guides on financial modeling today, but those guides are actually just commercial products to promote some services, educational services or things like that. They don't play a very huge role in financial modeling as a topic, as skill. So financial modeling is more a skill that you learn by doing, by modeling. So the main part of my course, and here we have actually advantage by the fact that our lectures, our courses are completely online now, because yes, we will lose something in our interaction during the lectures, but we will get more by the fact that we can interact between the lectures much more. And I believe that the main part of your study is not what you're doing during the lectures, but what you can send me as your intermediate work, as your final financial model, and so on. So the main idea is that during the course, you will have to develop a financial model for your own unique project. And you will have to choose this project yourselves. So what is this project? You will see my example. My example will be a cement plant, construction of a cement plant. And you can choose an example of constructing some manufacturing facility, launching some any kind of production, any kind of new service company, or whatever you want. And you actually can choose a venture project. The only thing is that we'll have some technical issue with venture projects, because the lecture on venture projects will be the last lecture in the course, and actually the beginning of this lecture is our deadline for financial modeling for your assignment. So we will have to discuss with you individually before the lecture possible applications for your project of general approaches used in financial modeling of venture business. But this is not a big problem. I can talk with you individually your issues, your tasks with your project even before that lecture. So the first step, you will have to choose a project. That should be the best choice is an industrial project, because with an industrial project you will easily apply all general approaches to financial modeling to your project. So small or medium scale industrial project, or maybe any business, but preferably, if it's not a venture project, it must be a business that can be financed with a loan or with a lease. Just because for our education purpose, we need to study how to model financing in the project, and we need something that uses loans, leases, and things like that. So you choose the project, then you'll build for that project your forecast. You will model your assumptions, then you'll build financial reports, make DCF analysis, finance your project, and then you will apply sometimes it's scenario analysis, sometimes it's other kind of what if analysis within this project. The project you choose, it can be a real project if you have one, It can be a fictitious project. If you use a fictitious project, then you should be careful with choosing the parameters of this project so that the project would be feasible enough, profitable enough to finance it and to analyze it seriously, but no other restrictions exist for this choice. Important thing, when building your model, if the model isn't perfect, this is not a big problem. Sometimes I can even give you high mark with imperfect work if I see that you really try to apply all necessary approaches, models, standards, and so on. I understand that everybody make mistakes with the models, so your mistakes will not create a big problem for your mark and for our interaction. But I cannot accept any quantity of plagiarism in your model. So please don't use any template or model that you downloaded from the internet. Don't use any template models or anything that you got from your company as a part of your job. Don't use templates or models that you could download or that you got from other courses. So this must be your own work. And basically, you can use the model from my course, of course, because studying this model is a part of the course. But you should be aware that I cannot grade my work. So if your model is essentially my model with changed list of items or changed numbers, that means that your work is minimal within this model, and I will not find anything to grade. So you can use parts of my model, you can use it as a basic template, but please make sure that your own work in this model is palpable enough to grade something. So the principle of studying in this course is that you can see how I build my model, you'll build in your model, and we'll be discussing what questions you have, what model you have by any lecture, and so on. And this model, if you just build a model and this model has a budget and DCF analysis, this is like about 80% of the highest grade if you have no error in this model. To make it 100%, you should do something of this. You should either use a full-blown scenario analysis in this model. We'll discuss that later. For a venture capital model, you will have to build a multi-stage cap table. And again, we'll discuss what cap table is. And unfortunately, just because I have to plan schedule for the lectures, and at the same time you will have you'll need time to build your models. Sometimes your work will be ahead of the lecture, but we can discuss it ahead of the lecture. If you don't need scenario analysis in your financial model, if it's not a venture capital model, think about how you build, how you model your parameters for this project. Think about drivers that drive revenue, costs, and so on, and develop a sophisticated model to forecast those drivers. A model like this will be 100% model for the great purpose. We have schedule not just for lectures but also for your work, because if you think that you can develop the model somewhere at the end of the course, basically you're not right, because from my experience, you need 2, 3, 4 interactions with myself to discuss the model, to make it error-free, to prepare everything that needed for a good model. So, and for those several interactions, you will need time. Until, by the way, until the last lecture, or not until the lecture 7, until the submission, I will be available for your questions basically at any time. But the last week, by the last week, I cannot promise that I will be available immediately. Sometimes it takes 2 or 3 days to get the answer, and that's because many of you, unfortunately, put all your work to the last week, and by the last week I just overwhelmed by submissions or questions or anything. So if you want to be to get the answers immediately, if you want to have access to, I don't know, additional Zoom sessions to discuss the model or things like that, ask early. So like next week or 3 weeks from now, I will be available immediately. Later, I cannot promise that. So by the next lecture, we have the first deadline. By the next lecture, you will have to declare the project you'll be modeling. So by the next lecture, the first step is to say that your project is the project with this name and these basic parameters. The next lecture is our deadline for all the data you need for this project. So you will have to, you will see, even today, you'll see what kind of data you need for this project. Then by the lecture 4, we need to discuss your financial reports. By lecture 5, we have to discuss your final budget with all financing, financial reports, and so on. Lecture 6 is for analysis, DCF ratios, anything you want to put as the analysis. And the lecture 7, or specifically 8:30 on the lectures day, is the last time for your submission. If you send the model before lecture 7, then you have a choice. If you're happy with what you get from your model, if you're happy with this mark, and again, unfortunately, you'll not get your mark immediately. I need some time to grade it. So you'll get your marks maybe after 3 or 4 days after your submission. So if you're happy with your mark, and if you submitted your work, you don't need to sit for the exam. If you haven't submitted your work by 8:30 on the 7th lecture day, that means that you don't need to submit it. it's too late, and you will have to sit for the exam. And the exam looks like that. It's 3 hours. You'll have a description of a project, and you'll have this 3 hours to develop a financial model for this project. So this exam looks like the same as the whole course. The only difference is that you will have to develop this model for 3 hours. Of course, nobody expects that the model you develop during the exam is as sophisticated as the model you can develop during the course. But actually, I don't think that this is a good idea to sit for the exam, because with the exam, you just have a mark, and with your home assignment, you will have a real study. Okay, until 11th of December, as I said, until the lecture 7, you can contact me online anytime. If you have a model to discuss, or if you have a question that can be discussed in writing, then just write me an email. If you have something to discuss already, then you can ask for a short session, and I will send you a Zoom link and we'll discuss it face to face. And during the course, I will put some information on my Dropbox. 1 second. I'll put this link in our chat. So any file, any file that 1 second, no, to all. Any file I will publish for you, you can find here in this folder. I will update the content of it's empty now. The content of this folder throughout the course. Okay. So that was some brief housekeeping part, and now we can start with some general principles of financial modeling. As I said, there's no theory on financial modeling. When we talk about standards of financial modeling, we don't actually mean any specific document or book or standard setup. Those standards are just generally accepted principles that are pretty vague, and actually we can put it simpler. A good model is a model with correct calculations and full transparency, and actually beauty. This is another important thing. And by the way, in your models, this is an important part of the modeling process. You should build a model, you should develop a model, not just correct, but you should develop a beautiful model. And this is a very important thing for you, because your professionalism will be measured not only by arithmetic calculations of models you develop. No, any financial model is not just a calculator. Financial model is a mean of presentations. You present your project, your ideas, and so on by those financial models. So their ability to deliver your ideas clearly and effectively, those abilities are sometimes even more important than detailed calculations and things like that. So think about visual attractiveness of your models the same as you think about your calculations. But as I said, we don't have standards. Nobody can set the rules for those models. But we don't have actual standards, but we have some attempts to develop a standard. And some of those attempts are pretty successful, and we can use the approaches used by those people as some, maybe not as an industrial standard, but as a proxy to an industrial standard. What are those standards or sources of information? The most well-known standard is FAST. FAST is abbreviation for something. I don't remember actually what is it stand for, but the FAST standard is developed by F1F9 company. F1F9 company is a company, and this is a British company specialized in project finance, financial modeling. So the FAST standard is basically aimed to financial models developed for project finance. And project finance, as you probably know, is the most the biggest type of capital investment projects. So if you have a project heavy enough, full with details, and the project using a lot of parameters, drivers, assumptions, and so on, then FAST standard will help you a lot to deal with this type of information. And by the way, there are many differences in approaches used in project finance and in business valuation. So actually, if you want to research the market of financial modeling, you will find that there are two types of two walls of financial modeling. Financial modeling for valuation of a public company is one type of financial model, and the financial models for a project analysis is another kind of financial models. So this time we focused on financial models of the second type. So FAST standard is one example of the standard we can use as some initial guide for our models. Another attempt was SMART standard, but it was developed by Carality company, and now they bought by Mazars, and now they are a part of Mazars company, or Mazars, because it's a French company. I'm not sure how to better call it, Mazars or Mazars. But SMART standard wasn't actually developed as a fully fledged standard. It remained as just examples of financial models, but those two sources, FAST and SMART, became later the basis for most international courses on financial modeling, certificates on financial modeling. There are some certificates on financial modeling. For example, Financial Modeling Institute is actually very closely related to FAST standard. They have some interconnections with F1, F9, and so on. Corporate Finance Institute has another certificates. This is an American company, and I don't think that their certificate is strong enough, but the company is strong enough as a educational company. So these are the basis that these two standards are the basis that we can use in our general approach to financial modeling. And what can we find in the standards like this, in the rules like this? They are actually mostly about low-level financial modeling, the basic rules of good style for financial models, and we'll discuss some examples of this style. And these standards cover things like how we use spreadsheets in general, what components of financial model we create in any financial model, what are our standards of transparency and clarity, how we use numbers, formulas, and so on. Well, let's go through some general rules that appear in most recommendations, guides, standards. So, the first, structure of the workbook. If you build a complex financial model, you have a lot of information. You probably have a lot of reports, financial ratios, assumptions, some additional calculations you need to develop the model, and so on. And in Excel, you have a sheet with 2 dimensions, and you have the list of your worksheets. And the good style is to use those worksheets as your 3rd dimension to make your financial model more navigatable. So basically, you have the following list of sheets in your financial models. You have your foundation sheets, like technical parameters, calculation of your timeline, macro, and so on. You have 1 or several worksheets with your project assumptions, like sales, costs, capital expenditure, financing, and so on. Then you have financial reports. Basically, we have 3 financial reports in most models: income statement, cash flow statement, balance sheet. You have some analysis, financial ratios, DCF analysis, and so on. And you can put them, any piece of these reports and calculations, you can put on a separate worksheet. And then you have presentation worksheets, like your charts, maybe your KPIs for the project, and so on. And again, you can use separate worksheets for them. But from the list I presented here, you can see that if we put any type of, any piece of model on a separate worksheet, we'll have actually a lot of worksheets, and it can become hard to navigate again in Excel, just because you have 30 or 40 worksheets and you don't see them at the same time. You cannot easily find any piece of information you need in this model. So it's hard to navigate through 30 worksheets. Because of that, I'll change my second. Because of that, sometimes it's easier to have models like that. Well, I'll show you the model that will be building through the course, and you will see how it looks like by the end of the course. We can do it this way. For example, we put all our macro assumptions on one sheet, then we create one sheet for all our project assumptions, like sales, raw materials, general expenses, and so on. Then we have for financial reports, one separate sheet, one sheet for our analysis, charts, scenarios, things like that. So you actually have a choice. You can put everything and any report, any block of information of your model to a separate sheet, or you can develop sheets for sections in your model. So these are two possible approaches. And just like it is very recommended to put your model on several worksheets, it is highly not recommended to split your model across several workbooks, several files, because first, it's technically challenging, because Excel keep everything sound within the model. If you change something on any worksheet, your formulas will be recalculated, relinked, and so on. If on one worksheet you removed a row or a column, then all the formulas will shift together with this change. But between several files, the same principle doesn't work. So if you have a model splitted across several files, then if one file is edited, you can crash all the links, all calculations on another file. And if you see it crashed, it is the least problem, because the most important case is when you don't see that something crashed. When the formulas shifted, they actually get the data from the wrong cell, but you just don't see it because maybe your data now taken from an empty cell, and this zero doesn't generate any error in your calculation, so you just don't see that the numbers are not correct, and so on. And another thing is that when you develop a model, you actually eventually send it to somebody, and you send it usually by email or by some messenger and so on. And when your recipient receives this model, and when they open it, they see that this model has links to some external files, so they see that some calculations are somewhere out there, but they don't see those calculations. Even if you send both the main model and the file linked to this main model, they will not open it easily, because Excel loses this connection when the files sent from your disk to another user. So it is very hard to work with models split it between across several books. So avoid it if you can. If you can't, if it's impossible to avoid external workbooks, maybe because uh, several people work with this financial model, and you need to give access to one part of the model to somebody and to another part of the model to another person, or maybe because the model has some source of data, and this source of data is too big to put it to the main model. So you have to calculate something separately in another file and then transfer information into your model. In this case, the best approach is to develop and export and import table in your two models and in your two files. So in one file, you develop this export table with all the information that will be transferred to the main model. And in the main model, you develop the same import table. And in this import table, you link all the data to your initial model. Actually, you can even leave it without any link. You can copy it manually. And that sounds strange. Why you need it? But it makes your model cleaner. It with this approach, you get rid of these external links. You get rid of warnings for those who open your model that this model has some external links and so on. And some standards like FAST recommend this approach. So they recommend avoiding any external link and build this export import table instead. But maybe they too careful with these links. You can put the links, but if you have this export import table, then you can always easily find where your two files are interlinked, and you can easily find if something goes wrong with your model. You will see it quickly, and models like that have more chances to be error-free. Okay, the next question. So we decided that we will split our model across several worksheets and put information on those sheets. Within a sheet, all the columns of any worksheet should always have one distinct type of data, one distinct role. And those roles are usually like this. They more or less the same for all models. So we start with the item for any line in the model. Next column is our units, and yes, this is important. We have units for any line in our model, and we, even if 90% of our calculations are in dollars or in rubles, so the unit is the same for all those lines. We repeat those units name each time for each line because it's important to always see those units. In real life, when you work with the models, sometimes there will be some lines with unusual units, and it's important to show that. So it's important to have this column to describe all the units. Then you will need, usually you need two columns for various reasons, but in all models, something appears for those columns. One is the column for constant values, and by constant I mean the values that are the same for any period in the model, like I don't know, tax rate or things like that. Although in many cases it's more convenient to put even constants in the periods and repeat them in each period, just to make calculations, your formulas more clear, so that all the items in the formula would refer to the same column. Okay, so we usually have one column for constants, and then we have something like this, some technical column in which we do two things. First, sometimes we need technical flags to manage our calculations, to switch on and off some calculations, things like that. They even if you don't plan them, they appear later, and you'd better have a column for them from the very beginning. Another possible use for this technical column is for calculations like, for example, if we have a loan. I'll show you that. One second, I'll switch the phone. Okay. If, for example, you have something like this, I have a loan, and for this loan, I have money I receive from the loan. I have my repayments, right? And I have outstanding balance. Let's start with a very simple principle. I've took some money, taken some money, then more money, then I repaid. And now I'd like to show my balance for this loan. And this is, yeah, this is something that I just edited as a parameter for this loan as my assumptions. But the balance outstanding is something that I should calculate. For the first period, my outstanding balance is simply equal to what I got from this loan. In the next period, I will have to take what I had in the last period plus this cash flow, right? Okay, but now I have a problem. I have a problem, and we'll discuss this problem later as a general principle for financial modeling. But the problem here is that I have one formula here in the first period and another formula here. That makes my line, this line is twice as more complex as compared to what I have is my formula would be one and the same for all periods. How could I solve this problem? What if I had a technical column, empty technical column, which is known for me that it's always empty? Okay, if it's always empty, I can start with the same formula as in the second period. So now I have one and the same formula for all periods in my law. This is why I need this technical column, so that all accumulation formulas, and we'll have a lot of them, all accumulation formulas would be the same for the first period and for the next period. Without this technical column, I could not work with a formula like that, because I have reference to the line with item name, and I cannot put it in the formula. So this is another reason why we need this technical column. And then after that, we have, of course, we have a set of our periods for the project, for our business, for our forecast. And now we have a choice. What we put, should we put something in the first period here? There are various recommendations on that. And actually, you have several possible things that you can put in this special first column. First, you can do it like this, like here. So the first column is the beginning state of the project. In this case, instead of linking this technical column in your accumulation formulas, you will link to this first column. And additionally, if your project has some initial information, maybe, for example, this project is already started, and we invested something, we spent something, we had some have some outstanding loans already, so we have to put them in our model as its starting balance, as initial state of the project. In this case, we can create this initial beginning period, the beginning state of the project in this column, and we will use it in all accumulation formulas as well. And this column will be just technical column. And another thing is that sometimes some guides recommend to put here total values for the whole project. In this case, probably you can move your technical column after this total column. Why you put all your totals in the beginning of financial model? Because imagine that you have a project that should be modeled quarterly, because in many cases this is the requirement from banks to show your financial model by quarters. And you have this project for 10 years. 10 years project by quarters, 40 columns. That means that when you work in the beginning of your worksheet, in the beginning of your model, you just don't see the big picture of your model. You don't see how much you have in any line of your project. And this initial total column would help you to work with that. Alternatively, you can put this total column in the end of your model. This is just maybe a matter of your preference. There's no standard on that. But there is something good in putting total in the beginning because you can see all the numbers in this line, and sometimes it's better to put it in the end to have this column, but to free this beginning space for your work with the data, with actual periods. So it depends on your preferences. Another thing, just like we can put each piece of information in the model, each block, on a separate worksheet, we can do it another way, just as I did it here. Look, for example, we will start with some obvious thing. Yes, all three financial reports in this model are on the same page, on the same worksheet, but you can easily work with income statement, cash flow statement, and balance sheet, and so on. Of course, because they are visually separated. They are visually three separated blocks. But we should do the same with all the information in our financial model. For example, sales here. So we have sales block, and this sales block should have at the end of the block some totals that will be used in financial reports, in analysis, and so on. So the basic rule is that in a good model, anything inside the block is used only inside the block, and all other blocks have links only to these final lines. And this way you can easily change any block, analyze any block of information without interacting with all the other blocks, because in a complex model there can be a lot of information and you will just lose yourself within all this stuff. So these visual blocks for each piece of each type of information will help you to work with complex models, will help you to change the model without crashing anything, help to read the model, and so on. So this is another rule, general rule for modeling. We'll just discuss this totals and the next part, time ruler. As we discussed now, that each column has its distinct role in the model, you will have to build a time ruler that will have all necessary titles for your columns, and that will be applied to all the columns. And after you create this time ruler, and this time ruler usually have not just the title, because yes, you need a title for your tables, you need the title for presentation needs, but you will also need a period number, because in some formulas you will refer to this period number, so you will have to create this period number first. Second, you will need something like planning step. Why? Because there are many formulas. Maybe the simplest example is interest for a loan. If we have a loan and we calculated in the model outstanding balance of this loan, and we know that interest rate is, for example, 10%, how much interest should be paid in this period? It's outstanding balance times interest rate, but it's only for a year. if our model is by years, if it's annual model, then this is our formula. But what if our model is in quarters or by months? In this case, we should add to our formula, to our model, a formula to account for the period length, right? And to make it more universal, we will have this planning step or period length as a parameter in the model, and we will refer to this parameter always in all our formulas, so that in any model we'll be ready to make it by years or by quarters or by months. And specifically, in many cases, especially when we planning by years, in many cases, our first period, so all periods in our model are in years, but the first period has some other length. Why that? Because imagine, and our example project will be this way. Imagine that we're going to plan our project by years, but the project starts in July. So we have a choice. We'll have either plan by years and our financial year will start from July. But it's inconvenient because usually when we talk about marketing, we talk about production schedules and so on. We think about calendar year. So it's better to have calendar years, real years in our financial model. But that means that the first period will be 6 months, not a year. And for that, we have this planning step that can be changed for the first period. And all our formulas in things like interest rate, discounting, some taxes like property tax, and other things like that, or inflation, right? They will always refer to the period length, to planning step in our model. So our time ruler will consist of this planning step, period number. Then we create period titles. Sometimes period title can be just like this, number, the year. Sometimes for 6 months, for example, we can generate something like this. And two other things we need for our financial model are beginning and end date of each period. Because again, for some calculations, like internal rate of return, for example, in our formula, it's better to have date for each period, for each payment. And for some other calculations, we always can easier build a formula with dates instead of just abstract numbers. So this is a minimum set of data that we need in our time ruler. And after we created this time ruler, this time set of time settings of our project, we put them basically like that. I'll the model without all the others, other information. Just simple first step. After we calculated all that, this is what we discussed now. We repeat sometimes just titles, but actually I prefer to repeat two things: the titles and the period number. We can make it smaller. not so bright, but we need it. And then after we created this additional 2 versions of our titles, we just put it here. Well, 1 second. And freeze. We put the cursor here and choose freeze panes, so that we'll always see this part of the model just as we always see this fixed part of the model. I do not recommend to freeze more than these 2 lines and more than these lines here, these columns here, because anyway, you need as much space as possible for this part of the model, because this is your working space. So keep these lines brief enough to save space for your work. But at least these 2 things you usually need. And by the way, you will repeat these titles again in each table you create, even if you have it here. It's important, and I will show you why. Because in this full model, I will show you why we need these frozen lines here. Because when I scroll the table, sometimes I don't see the title of the table. So with this frozen part, I will always understand in which column I am. But I still need the title, because if I want to copy this table to some broad presentation or whatever, I will not copy this part. I will copy the table. Okay, and I will move the table to this presentation. And at this moment, I will need this title. So I need both these titles with all the periods, and I need the frozen line here. Okay, time ruler is the next thing we need in our model. Then, okay, let's go from the worksheet level to each separate cell, row, and column. For our rules, some basic rules are: first, the rule we discussed, 1 row, 1 formula. You should never do something like this. You should never change formula somewhere here, because from this year you believe something changed in the principle for this item. You should never do that, because you will never find this change. The other people will never find the change like this. So you will lose control over your financial model. So a good model is a model where the first line explains, the formula in the first line explains the whole row. So in the first column, explains the whole row, and you will not need to check the formulas here. Another thing why you need the principle like this is the idea that you actually edit formula here, and then you just distribute all the data to all periods, right? This way, or you can just choose everything and press Control R to copy all the formulas. And if your formulas always like this, prepared like this principle can be used without any analysis of the content. I understand that I can copy the formulas for this block, and something was changed, and that's probably what didn't work. This is accumulation here. Yeah, here I quickly linked this to my constant. Look, we have two versions of the formula, and because of that, this principle doesn't work. And that's bad, actually. But sometimes we create not the perfect formulas. We could make it better with things like that. We could create an anchor so that we linked it to B, and then we just apply inflation, price index, something like this. And after that, everything would work. We don't always adhere all the rules, but the more your formula or your model are made with those rules, the easier is to do anything with your model without thinking about its correctness. Okay, so one rule, one formula. Each time you deviate from this rule, you will lose this ability to just copy and distribute every formula in your model. Basically, in real life, it's hard to keep all your lines with this rule. In some models, you still have the first column, the first period, with some specific formula, like like in my example here. But if you can keep it with one formula, you will see that your model is much more controllable. Second thing, think carefully about the names. Always use meaningful, correct names for each line in your model. And another important thing, if you used some name for some information, some type of information in your model, and then the same type of information used somewhere else in your model, use exactly the same name. This is it can look like something not important, but I saw how people work with models, especially not their models, models prepared by somebody else, and how they try to read the model, to understand the model. And I see that if one sort of data called differently in different part of the model, that creates a lot of confusion always. So think about each name of each line in your model and use the same names for all lines. Always use, for each line, always use units. If it's like rubles or dollars, let's call it rubles or dollars. If it's percent, put percent mark. If it's just has no unit, we usually use things like times or whatever. So that makes again the model the model with this look more like neat. You can be sure that you understand what's in each line. And by the way, especially for Russia and for Russian models, think about VAT. If you have price information in any line of your model, please mark this line. Is it price, or is it expenses or revenues with VAT or net of VAT? Because again, this is the most popular question to a model. Is it all with VAT, with value-added tax, or without value-added tax? And the last thing about the rules, when you create a model, sometimes you can feel that your model is too big, and to make it more compact, maybe you can hide some technical calculations, or you just didn't think about visual presentation of those calculations. You think that it's not important, and you decide to hide those lines. Do not do that. Never do that, because this is always this is an example of the worst style in financial modeling. Never hide anything. Some people even don't recommend use grouping as the way of presentation of the model, and they say that no, you should never use grouping. All your calculations should be open for the user, and you should just make your model compact enough and readable enough, with all lines and columns visible. I personally use grouping. I believe it makes the model better, but this is not a law. This is just what I prefer, and you can use it. You do it another way. Okay, now let's go to the cell level. For each cell in your column, it's better to use color coding to show what's in this cell. It's very important to show to the user of your model, is it an input cell where the number is hard-coded, where it's just typed in, or is it calculated cell? So the minimum rule for any financial model is that all parameters, everything that typed in all input cells, should be visually distinct from calculated cells. So at least we have two color styles. Some people use for the input cells style like I don't know, blue text. I prefer using blue background just because it makes them more visible. And another thing, actually, because sometimes in my models I use the style like this. If I believe that for current version of the model, some parameter should be empty, should not be used, or have zero values, I just delete everything. But just because I believe it looks more beautiful when you have instead of many zeros, when you have just empty line. And with this style, if you removed anything, that you just don't see that somebody should be entered here, that somebody should be typed in. So because of this, I prefer background for our input cells. But this is up to you. Another possible styles are links to external files or special flex switches that we use in the model. Maybe sometimes some other parameters or other type of information. And if you have some color style for your cells, then please include a legend to the model so that anybody can see what style you use in this model for your data. And now, what's inside those cells? First, we should think not just about the colors. We should always think about our number formats, and this is actually this is as important as all other visual presentation issues of your financial model. Just compare two versions of the model. Look. Let me open again. Played with it too much. So compare this model. It looks neat, professional. It's easy to read, and something that you get with general format. If your model looks like that, it doesn't matter. Is it calculated correct or not? Anybody wouldn't see anything good about you actually as a author of this model, because it's hard to read this, hard to understand, and as the model, as I said before, is not just a calculator. It is the way to present your ideas, the way to present your point of view. This just doesn't work. So you can lose all the effect that you were building with this model because of these visual things. So think about formats. Use clear formats so that anybody could easily see what's in this cell, what type of data you use, and so on. For similar data, always use similar formats, and that makes it easier to read. And the last thing, now inside most our cells, we have formulas. For those formulas, use like a rule of thumb. If you can read and understand the formula for 20 seconds, then the formula is okay. If it takes more time to digest, it means that probably you will have to decompose this formula to make those calculations step by step, maybe in several lines, to show the flow of calculation and to make each formula much easier. Because look at the formula below. What do you think is calculated in this cell? Can you guess what's calculated here? It's very hard to understand formulas like that, and here it's even easier to read because I highlighted the names of functions. In Excel, you don't have this pleasure. So in Excel, the formula like that will just blow your mind. It will show you that this calculation is not transparent, absolutely not transparent. And the reaction will depend on the position of the reader. If those who try to understand what's in the formula they cannot I don't know judge you they will feel just I don't know, desperate with your model. And if they can judge you, then their judgment will be not good for you. So this is not a good style of modeling, and this will make all financial models worse than they can be. Another thing about models, about formulas you use in the model, is that if you know some very advanced functions in Excel, then probably you should curb your knowledge and avoid those functions. Things like I don't know, array formulas, formulas like this example, they can create a very compact maybe calculation, but for most Excel users, they are too sophisticated to understand. And again, that makes your model less transparent. So if something can be calculated just with arithmetic, just avoid formula or functions that not necessary in your model. Well, so this is how we calculate everything. And the last thing about content of cells is signs and symbols we use in our formulas. First, we have a choice. Let me return to a project. For example, here, sales. For our sales, of course, our price or capacity, they are positive numbers. So we don't have something to choose here. But what about, let's look at something like a loan. Proceeds from the loan are positive numbers, but repayments of the loan, are they positive or negative? We have a universal convention on the numbers for this negative payments. In our assumptions, all our numbers are always positive. So repayment of the loan is positive number. But in all financial reports, let's return it to readable version. In all financial reports, we have the rule that all inflows, all income, revenue are positive numbers, and all cash outflows, expenses, everything that goes from our company are negative numbers. So here proceeds from the loan remain positive, but repayment of that we had as positive numbers here in financial reports, they are negative. So when we read financial reports, we can quickly see the direction of payment from the sign. So this is the rule that we use in all financial reports that we generate from our cash flows. Okay, the next thing. This is actually about spaces. Yes, this is not a very important thing, but just remember that in Excel you can use spaces in your formula, and that makes sometimes that makes formulas more readable. But I don't think that this is a very important thing. Some people use spaces, some not. Me personally, sometimes I use them, sometimes not. And before we go to the next thing, next general rule, I think that we should make a break because it's time, right? So I don't think that we need too much time because we all home. Maybe 10 minutes will be enough. Okay. So now it's 8:05. Let's meet again at 8:15. Okay, let's go. So, 1 second. The next important thing about your models is that you should never put any constant inside the formula, except constants like maybe changing from units to thousands of units, or like p. And for example, even the constant like this is not always good, because we can find a model where, like in our model here, where some periods have 12 months, but some periods have 6 months. And why you should never put constant in the formula? Because even if you believe that for this model, this constant has always the same value, and we don't need anything to explain. For example, here, VAT received with those sales. We could write something like this, because we know that VAT is always 20%. But with formula like this, we now don't have explanation. We don't have explicit mention that we used VAT of 20%, like in here. So our model became less transparent. And sometimes people use actually something like, I don't know, like this. For example, this number, and they think, okay, we have special inflation index, so we have to add times 1.04 or something like this. This case is the worst case of incorrect formula. So because I cannot guess that I will find this index here, I don't understand what it means. Okay, if it's 1.04, I can guess that it's our inflation. But what if it's something like 1.13? Because you had some index for some reason for this item in your business. And when I see that, I understand that I'm losing something. I'm losing some information about this item, because it's transparent, and I cannot understand how to deal with that. So if you have any constant, create a cell for this constant, create the cell in a separate line, probably sometimes, give the name to this constant, so that everybody could understand where is it coming from, and what is in its name. So with that, it can be easily dealt with, and with formulas like this, just nobody understands those formulas. So this is all about general style. Just some thoughts about how we create formulas. If we have accumulated sums, that in most cases you need create both outstanding number at the beginning of period and at the end of period, because this approach makes the formula much simpler. In some case, you can create a simple formula. just with outstanding debt at the end. But if you feel that you need something like this, some complicated formula, then you can just go to outstanding debt, for example, for a loan at the beginning and at the end. And by the way, in the case of the loan, this outstanding debt at the beginning and at the end of the loan will give you some very useful thoughts about how we calculate information with this loan. Because look at the first version of the loan. Imagine now that I add a line, one line, interest rate. And interest rate for this loan here is 10%. Now, how do you calculate interest expense for this loan? The idea looks very simple. I use this outstanding debt times interest rate, and this is my interest expense. Now go to the second version. Again, I add interest rate here, interest expense. And now the question is, what should I use for my interest expense? Outstanding debt at the beginning or at the end of the period, or maybe average? And the truth is that we don't have one correct answer. But this is a very important thing to understand this difference and apply the same rules for all items in the project. We'll see that later. Okay, some other formulas. If you can avoid if in your formulas, avoid it. Sometimes you can use choose instead of if. Sometimes you can use even index, and index is better than choose for choosing numbers, and choose is better than if. So if you have formulas with choice, with different options, then first think about using index, then about choose, and only then about if. Formula of functions like offset or indirect are very bad for the readability of your model. So avoid indirect always, unless it's completely impossible, and be very careful with functions like offset. Why? Because if you use indirect or offset, then I cannot trace dependencies in your calculation, because Excel cannot understand where those numbers were taken from when you use indirect or offset. And for people, it's hard to read as well. Iterative calculations. Iterative calculations is a very interesting thing, because in project finance, I don't know, maybe you didn't use iterative calculations in your Excel model ever before, but in project finance, iterative calculations used widely, very widely, because with iterative calculations, you can auto calculate necessary amount of debt used to finance the project. And without iterative calculations, it's very hard to do that. But iterative calculations is a very bad thing for the style of your model. First, it's a bad thing because it makes the model harder to read. Second, it makes the model harder to control, because for example, I have an outer fitting loan, so my loan is always covers all my cash needs. then I change something in my project, and I don't think that I don't have enough money, that I have negative cash because of a high investments rate or lower sales and so on. No, my loan will fill any cash need automatically. So my project always looks good with this auto-calculated loan. And only in this loan information, I can see that something goes wrong because I have too high a loan, I don't repay the loan, and and so on. So it makes any model less controllable. And the last thing is that with iterative calculations, sometimes you'll have technical issues with Excel. There are two possible technical issues you can get. First is the message from Excel that you have circular dependencies. Basically, we can switch this option off and on. So if we have iterative calculations, if we prepared to develop a model with iterative calculations, then we tick the option iterative calculation, and Excel stops giving us this warning. But the problem is that this option in Excel works not for a workbook, not for one file, but for the whole application. And that means that if you build a model with iterative calculations that works completely okay for you, and then you save this model, open it, everything works okay again, and then you open in Excel some other file, any other Excel file, the file that doesn't use iterative calculations. And after that, you open your model and you get this warning that the model is incorrect. It has circular dependencies and it will not be calculated correctly. Why? Because that first file opened in Excel sets this option for itself, and it doesn't change for any other file opened together with this first file. So your model stops working, and you can get the opposite. If you open your model and then you open some other files, and in those files you don't expect to use circular dependencies and iterative calculations. If you make a mistake in those models, Excel doesn't think that this is a mistake, because it believes that for all files opened now in the application, iterative calculations are on. So this is a first technical problem. Another technical problem, technical issue with iterative calculations is that sometimes they just break. They stop working. So after some changes in your model, you can get all of a sudden an error message in all iterative cells. And even if you change the number that you edited the last, nothing changes. So the only way to do something with these errors are to save this file and then open it again. I don't know why, but that's the problem with Excel. And actually in some models using iterative calculations, there are a special switcher, a special flag that can give you ability to switch off all iterative calculations and then again switch it on. So if everything crashed, you just switch off iterative calculations, switch it on again, and everything works again. I don't know why, but so iterative calculations is a very fragile and dangerous tool, but very powerful. So we use it, but use it with care. Functions like SUMIF or COUNTIF are used very widely as some simplified version of database functions. And you can use them, but think about the amount of calculations generated by those functions. Sometimes people create SUMIF functions or COUNTIF functions of formulas to fetch information from a database, and then the model just stops working because the amount of calculations is huge, and Excel just cannot do anything with this amount of information. So you can easily create very heavy calculations with these formulas. And the last thing about formulas, formulas like NPV or IRR, we never use NPV, never. Why? Because it's very easy to calculate NPV without NPV function. And in NPV function, we'll lose some very important information about how we calculate our NPV. And we, in financial models, we don't use IRR function as well. We cannot calculate internal rate of return without IRR, but instead of IRR, we use XIRR, because IRR calculates internal rate of return always for a model or for a cash flow by years. And in our model, we sometimes we have information by years, sometimes by quarters, sometimes our first period is like in my example, 6 months, then 12 months. And for cases like this, XIRR can do anything we need. So of these three functions, we use only XIRR. And about macros, if you going to use macros in your financial model, okay, do it, but think about your macro as about a program. Don't use things like generated macros. If you are going to use a macro, then think about comments in the macro, think about style or programming style for this macro, and so on. And anyway, even then, be very careful with using macros. They they make the model more complicated for usage and for anything. And for some things like controls in the model, we will use just other ways of doing things. Like, for example, data validation can create our controls in the model. We'll see that later. Okay, so this is more or less our introduction. This is our general principles, and now let's talk about the project I'll use for my model. This project will be a cement plant, and that will be some fixtures, cement plant that we build from scratch. It will have capacity 1.1 million tons a year. It will be located in Russia. We'll start this project in the middle of the next year. So our model will be from July 2022. To build this plant, we have total capex about 8 billion rubles, and we'll finance that with 2 billion rubles of equity investment from the owner, and all the other will be financed with a loan. For that loan, we'll think about its interest rate. Maybe we can think about different currencies and so on. Construction period will be 2.5 years. Then we start working. First 6 months, we'll work at 60% capacity, and then the next year it's 90% capacity, then 100% capacity. We won't talk about marketing part of this business, so we will discuss the model just as if everything as if we know everything about its future, and we proved this forecast. Current price for this cement, for the most standard cement for this plant, is 4,000 rubles a ton, including VAT. So this is the first information that we need. Then we will need, of course, detailed information about our capital expenditure, general expenses like production expenses, maintenance, and things like that, administrative expenses, commercial expenses. We need information about working capital, how much days in inventory we need to work with this plant, what we expect with our accounts receivable, accounts payable, again in days, and then we'll calculate all the others. So we will collect all this information later. But before we go to these assumptions, first thing we should decide is the general parameters of our model. First, this is project scope. Where our business starts and ends. I will show you what I'm talking about. The project scope and point of view for this project. The project type and how we'll model this project, planning horizon and step, and the elements of our model, those building blocks for the model. First, the project scope, the project boundaries. Imagine this cement plant. Where does it start, this business, and where does it end? Look, we have a deposit of our raw materials, and we take our raw materials from those deposits and deliver them to the plant. Yes, then we produce the cement, and then we deliver this cement to the users. So what should we include in the investments of this project, and where should we define our prices? For our model here, we will simplify this project. We will imagine that we buy our raw materials. Not always the case, right? Actually, in most cases, we don't buy raw materials for cement plant. Instead, we invest in a deposit of raw materials, and we build our plant next to this deposit. But it depends on the project. In this case, just to simplify our calculations, we say that everything that goes before the raw materials come to the plant, we ignore. This is not our business. And the same way, everything that happens after we delivered, after we sold our cement from the gates of our plant, is ignored as well. Although in many cases, in many projects, we will have a distribution chain, and in this case, we would use the price of cement, not at the plant gate, but at some final users. So we should understand the boundaries of our project, just to understand what capital expenditure we should include in the project, what should be counted as our expenses, and what's just insider expenses for us, like if we bought a deposit of raw materials. And where should we take our prices? If we sell in our model, the product from the gates of our plant, then we should use the prices for this type of delivery. If we deliver goods to the final user, then we can use prices for the final user. So this is the first thing we should decide. The second thing, whose point of view we should use in this financial model. And in this project, we have actually many other participants. We have an investor, we have a project company, we have the seller of our equipment, we have the buyer of our products, we have a contractor who built the plant, we have a lender who lends money for this project, and we can actually list even more participants. All those participants have their own interests in this project, and when we say that the project is efficient, that the project is profitable, then the next question is profitable for whom? Profitable for the project company. This is the most standard answer. So we model the project company. Usually we model the project company, but profitable for the project company doesn't mean profitable for the investor. Sometimes the project company can be profitable, but the money is taken by the lender or somebody else, and for the investor it's unprofitable project. Or maybe sometimes it's okay for the project company, it's okay for investor, but the project has unacceptable terms for the lender, and so on. So usually in the center of our model is the project company. When it comes to financial ratios, we will have to decide what do we use. And the most popular choice is between, again, still the project company. And if you on my or the others valuation courses, or if you know how valuation is done, then you should know the term free cash flow to the firm. So free cash flow to the firm, it's how this project looks from the project company perspectives. And another term is free cash flow to equity. And that's how this project looks like from the investor prospects. So the point of view will be chosen when we come to financial ratios. Now, is this project a new business or an acting business? What's the difference between the new business and some operating facility? in the new business, and my project is actually the new business. The new business is the most simple example, because everything is in this model. All the investments, all the sales, costs, everything. So the financial ratios calculated based on the model tells us everything that they can tell about the project. But if this project is, for example, expansion or modernization of some business, we have a problem. The problem is that, yes, we have some capital expenditure, some investments in the project, and we have some sales, but not all of these sales are the result of these investments. We have the walk-in business, and this walk-in business generates some cash flows right now. We have some plans, yes, but those plans are not everything about this company. So for cases like this, and by the way, it's very hard to model just the project because of two things. First, because in many cases it's just too hard to separate this project from the other activities of the company. And the second is that because things like taxes are calculated on the company level. So if we don't know the company's data, we just cannot calculate some taxes. So we have two approaches here. The first, if we can isolate the project, if we can separate everything related to this project from the other information, then we build this model for the project. If not, then we create two scenarios, or two models, two versions of the models. First, how this business operates with the project, and how this business operates without the project. And then just calculate the difference between those two scenarios. And this difference is the cash flow of the project. So these two approaches can be used if we have things like expansion and modernization. And actually, sometimes we have a project, we have projects that just don't have any profitability. Things like social projects, safety projects, IT systems. Sometimes they just don't have to generate cash flow like with safety projects. Sometimes, like with IT systems, we expect that they will generate some additional cash flow for us, but we cannot calculate the cash flow that will be the result of this investment, because IT systems they aimed to enhance our company in terms of quality, in terms of some operating parameters and things like that. And we expect that those changes will bring us more cash, but we cannot calculate how much cash, and we cannot separate the effect of this investment from some other things like other new production lines or new marketing investments and things like that. So for projects like this, we just stop calculating profitability and instead focus on the budget. So we build the budget for this project. From this budget, we see cash needs and probably new loans and so on. But we cannot calculate things like NPV or IRR for projects like that. But this is not the case for our cement plant. For the cement plant, this is a project that started from scratch, from greenfield. So we analyze this project as the whole business. This is new business, and this is complete information about this business. And we will build financial model for the project company, and then analyze this project from the standpoint of the investor or from the project company. We'll choose later. About the project horizon. Choosing the horizon of this project, the problem that we have is that if I build a cement plant, I actually don't plan to close it after 5 years or 10 years or 20 years or 100 years or 1,000 years. Theoretically, I can reinvest some money to renew my equipment and continue as long as I want. So I don't have physical hard limit for this project. For some projects I have. In this case, my planning horizon is a very simple question. I will use the lifetime of my project. If not, then I usually use one of two things, or three things, actually. First, if I understand that my main equipment, my production line or things like that, the most expensive piece of equipment has some useful life, then I will use this useful life as the period, as a planning horizon for my model. This is the first possible approach. Second, if I understand that I have the loan for this project with some limit in term, and for example, I understand that I cannot get more than 10 years loan for this project, then this loan term will be my planning horizon, because for the bank, I will have to show all the schedule for the loan repayment. So at least to the end of the loan, I have to plan this model. And in most cases, I add 1 year to the end of this loan, just to show that this is finished and we have some other business after that. And the same thing is used for our sensitivity analysis and scenario analysis, because in some bad cases, maybe I cannot repay the loan for this 10 years, but it's important to show to the lender that at least for 11 years I can repay it, so it's not that bad. So the second possible approach is long term, maybe plus 1 year. And the third possible approach is very simple. If it's a small business, I will plan it for 5 years. If it's bigger, I will plan it for 10 years. Just to make some planning horizon for this model. And for planning step, basically the rule is, if it's for 5 years and more, I will try to use year as the step. But if I have a loan in this model, then I can expect that the bank will ask me for a quarterly planning. This is the way the banks usually look at the projects. So for the final model that used to work with the bank, I will use a quarterly model. If it's just some preliminary model, I do not discuss the contract terms with the bank, all the details. So this is just some general calculations. Even the bank can be happy with annual calculations. So basically, this is the choice between these two. If it's very small business, short project like 1 year, 2 years, I can calculate by months, of course, but you should be careful with planning step and with details in general. It can seem that the higher details we use in our model, the better is the model, but actually no. And the principle is that if the details of the model become higher than the detail of the data you actually have about this project, then the quality of the model deteriorate. So you should never build a model more detailed than the data you have. And by the data, I mean not the data about current state of the project, but also about your forecasts. So your model should not be more detailed that you can forecast, that you can prove. If you make a model more detailed, then you just lose control over your model, and this is a very bad thing. So this is about the planning step. But with the planning step, like years, and here we'll choose a year as a step just to make it more compact. With a step like by years, we have a very interesting question. Look at this cash flow and look at this part. We have it's in thousands of rubles. We have about 3 billion rubles investments. When was it? In the beginning of the first year, in the end of the first year, or maybe evenly distributed in the middle of the year? And the question is very important, because imagine that we have a discount rate 20% for this type of project. With discount rate 20%, this is a question with price 6 million rubles. Oh, so 600 million rubles, sorry. Right? Depending on our choice, we will account this initial investment as 3 billion, or we'll subtract 20% from this investments. So this is a very important thing. And we don't have one correct answer for this question. But general rule for the investment projects is that we put everything in the beginning of period. Why? Because look, sometimes like cash receipts from customers. Yes, this is not always true. We don't sell everything in the beginning of the year, but fortunately, we don't have in an investment project. We don't have sales right in the first year of the project, in the first period of the project. Our first period or periods are usually for the investments, right? And for the investments, it looks reasonable. Why? Because we start our investment project with the investments. So our cash outflow for the investments will start from the beginning of the year. Maybe still will be evenly distributed within the year, but the assumption that we have this cash outflow in the beginning of the year looks quite reasonable. And if yes, if our initial investments were in the beginning of the year, then our equity inflow and proceeds from borrowing should be in the beginning of the year as well, because we finance our investments with this money. So for most lines in our financial model, the idea that all cash flows are in the beginning of each project for the investment projects look reasonable. And by the way, if it were a business valuation model, then we would probably use instead the idea that all cash flows are evenly distributed, and we should use them as if they are in the middle of each period. But investment projects are different here. Now, how will we calculate all the information in our model? We have three sections in our financial model. The first part is our source data, is our assumptions about the project. We should build all assumptions about each block of this investment project. Then from this assumption, we model three financial reports: cash flow, income, balance sheet. And then based on these financial reports, we can calculate everything we like: efficiency ratios, profitability ratios, other financial ratios, and so on. With approach like this, so we never calculate those ratios based directly on source data. From this idea, what we get? We get reusability of our model. If you build a model like this, and then the next week you will need the next model for the next project, you will need to update only the first part. Your financial reports, your financial ratios, and everything will be the same in all models you make. So it just saves a lot of your time. And for this project, what building blocks we use for the project? The first part, our assumptions. All capital investment projects have actually the same set of assumptions. First, revenue. Second, direct costs. We always model direct costs separately from general expenses, because direct costs are variable costs. Direct costs are directly linked to the sales volume or production volume. And if we change something in the project, we expect that they will update automatically. So we have separate block for variable expenses for direct costs. Then our general expenses, that doesn't change with any change in our sales. Personnel plan or staff expenses, because why we need staff expenses separately from other general expenses? Just because taxing is different. We don't have value-added tax for staff expenses, but we have some social insurance payments and so on. And another reason why we plan our personnel separately is that in many financial models, and remember that financial model is not just to calculate NPV. Any part of financial model gives some information to the investor or to those who read the model. Number of quantity of personnel you use, and the number of workers or other people used in the project is another piece of important information about the project. So usually investors are interested in information about personnel. So the next block is personnel, then capital expenditure, everything that we invested in equipment, buildings, land maybe, and so on. Then working capital, money frozen in accounts receivable, in inventory, and so on. Then how we finance this project? We finance it by equity and by debt. So we have a block for equity, block for debt. So this is our assumptions. Then from these assumptions, we build income statement, cash flow statement, balance sheet, 3 more blocks, and then 2 standard blocks needed for any type of financial model for project finance is efficiency ratios and bank ratios. Efficiency ratios like NPV, IRR, and so on. Bank ratios, we'll discuss them later. Things like TD to EBITDA, DSCR, and so on. Ratios used in planning of our debt. And then to all this model, we will add another block with scenarios. Scenarios will change some parameters in the assumptions so that we can collect different versions of our NPV and so on in different circumstances. And we usually not put the scenarios inside the assumptions. Instead, we create a separate block where we collect all information about our scenarios. And the last thing we add to our model is summary with some key information about this project, so that people who work with the project, with the model, could avoid going through the whole model each time they need some key numbers about the project. So this is the elements of our project. This is how I will build this project. And from the next lecture, we'll be discussing my version of the project. And as I said, the most important part is not that, but your own projects. And by the next lecture, I expect that you will name your project and we'll start working with this project. And by the end of the course, I expect you'll have your own models. That's it for today. I'll copy the lecture slides and this model for the first lecture I used during this lecture to the file, to the folder link to which I posted here. And you can find everything from myself in this folder later. Any question?
Yes, I have a question. So
Yep.
should we take a project, not the company, to value? Can we take company, not the project, I mean, for valuation?
No. You mean valuation model?
Yeah.
No. This course is about project finance. So I mean, not the project finance in terms of in legal terms. We can use you can choose a small project, but it should be a capital investment project. If this project is within a company, then the project should be sizable enough, big enough to be comparable with the whole company, so that the company could be just a background for the project. But the topic is a project, not a company that just work with business as usual, and we just expect that this company will have the same revenue, the same cost structure as always, and so on.
Okay, thanks.
How to find info? You know, this is a question that always that I always hear this question, and I don't have one simple answer. So I can give you some sequence of approaches, possible approaches. So first, if you know a business that you're interested in, something, maybe it's not a business you know everything about, but you want to learn something about a business, then you will have some research work to collect information about expected capital expenditure, sales, costs, and so on. Yes, but if you're ready to do that, then you can go this way. So any real business that you want to analyze, you want to learn. Second, if you don't know a business like this, then you can just invent a business. Like this cement plant. Okay, you don't know how cement plant can work. Choose some business that you can imagine how it could work. What amount of equipment it needs, what are the prices, what probably the cost, and just use this fixtures project as your possible approach. And the third and the worst choice, I mean, the second is about industrial project. The third and the worst choice, if you don't know any industrial project that you can I don't know, imagine that you can fill with some fictitious numbers, okay, then choose small business. Choose a small business like I don't know, what it can be, a shop, or some service, something small. For a small business, I'm pretty sure that you can imagine expected investments, costs, and prices, because this is something that happens around us every day. And but this is not very good, because an industrial project is a good basis for modeling and analysis, and small business is not very good example. Just some things from small business, from our financial model, will not be applicable to small business. So these are three possible choices you have, and from my experience, going through these three choices, you will always find pretty quickly something to model. And of course, you have another option. It is actually more complicated option. You can choose a venture business. With a venture, and by the venture business, I mean something that expected to grow thousands times in the future, like IT projects and so on, but have huge risks and so on. For a venture business, again, if you have the numbers, so you can choose it. For a venture business, the problem is that a regular budget cannot be built. Loans are not used. Things like NPV or IRR are not always calculated. Instead, we use venture valuation approaches based on cap tables and things like that. And if you choose this business, if you start early, I will explain you how to adapt your model to this case, and we can make it. So this for options, 3 regular options through a regular investment project or venture business. I think it's enough to find something for you. That's it. More questions? Okay. So see you when? See you when? Let's check it. after all this breaks. Oh, is it 12th of November? Yes. Actually, I'm not sure, but you'll see the schedule. It will be either 12th of November or 19th. I believe the lecture transferred to 12, so it's not too much. It's not too much. Okay, so see you in 2 weeks. The question: the project should be in Russian? No, the project can be anywhere in the world. Okay, yeah, November 12th. Okay, so bye. See you.